Risk Management Agency's crop insurance price discovery period has ended. The projected marks are $3.86 per bushel in corn and $8.85 per bushel in soybeans. Those levels are noticeably lower from last year by 29 cents in corn and 88 cents in soybeans. The latest Cornhusker Economics article from UNL's Department of Ag Economics looks at net income risk for corn producers in Nebraska this year with the use of crop insurance. The study's authors, including Nebraska Extension economist Cory Walters, found significant differences in costs and returns between two specific counties in the state. Because of that, Cory says it's difficult to recommend insurance options that would apply to all operations. We talked with Cory Thursday morning and began by asking about the findings.
We were after building a model flexible to producer-specific characteristics. And that comes both from agronomic differences and, of course, economic differences.
Tell me about this study. You studied two operations, one in Saunders County and one in Custer County. What did you find that the differences were between those two counties alone?
Yeah, the primary differences came from family living and off-farm income going into that cost function. Also, expected prices that fall are quite a bit lower, or a little lower in Custer County. And just as important is that price-yield correlation as you move west starts to decrease. That brings back a little more risk to that farm in case of a bad probability event.
The prices are lower to the west because of basis primarily, yes?
Yes, that's right.
Okay, so one of the authors you're working with is a farmer, and he's saying, okay, so I have this data, but how do I use it on my operation?
That's right, yeah. The idea was to build a model that would allow you, anyone with farm-specific information, to identify what their risks are given their unique characteristics.
Which means what? As you look at some of the graphs and the revenue protections that you could select 85, 75, et cetera.
Yeah, so the outcome is definitely changes over both space when you're in irrigated Saunders or irrigated Custer, and also when you're in non-irrigated Saunders compared to irrigated Saunders County.
How big does it change? How much does it change?
Well, the results are a little surprising. Insurance picks up relatively about the same amount of revenue risk, but the farmer is left holding quite a bit different amounts of risk they face. They'd have to pay in case of a bad event.
Because?
Because the risks at those locations are different. The costs and the risks, those cash needs needed at the end of the year are also quite a bit different.
So for instance, how do you look at this? You have to have X dollars if you're trying to survive through a catastrophic event?
That's right. That's what we're trying to get is to identify how much money do you need to have on hand in case of a bad event happens. And in this case, we looked at a 5% event, which is then a 1 in 20 event.
So give me the dollars per acre that you saw that people might need to have on hand.
Yeah, so if you're in Saunders County and we experienced one of these bad events, you're looking at about $144 an acre in irrigated. If you jump over to rain-fed Saunders County, it jumps a little bit, about $24 or so to $167, $168. And then if you go out to Custer County, that value drops down to $115.
And that's with 85% coverage, yes?
That's with 85. That's the 85 trend adjusted, everything you can get into that policy that would increase that APH as high as possible.
How do you look at using crop insurance? Do you use it to protect revenue, to try and maximize revenue, to protect losses?
You're using it as a tool, or at least the way we're looking at it, is a tool to just allow you to survive into that following year. In a year like this that we're entering, crop insurance will start paying well after you're experiencing a loss. So there's going to be a good chance of losses that crop insurance will not pay that you, the farmer, has to pay.
So you should look at as to how much are you willing to stomach as a loss?
That's right. If you're willing to stomach a lot of wealth, to lose that wealth, then you can back down on crop insurance. If you don't have the wealth, you better be buying up on insurance, given that the insurance is working well for you, meaning that you have a good APH relative to your expected yield.
You can find the Cornhusker Economics article on net income risk in Nebraska corn production through a link on the Market Journal website. It contains more information, including graphs and tables with additional data.